Morning everyone. Today's topic is about the compromise, arrangement and amalgamation under the Companies Act 2013. Compromise is a very used word. When we have some dispute, we will go to a person to compromise anything. Compromise happens when full settlement of dispute. If both the persons have any dispute, they will come to a person to solve this dispute. But arrangement is there is no dispute, but it just modifies the right. If I have a book, for example, if two persons are coming together to buy a book, they will buy and share it. This is an arrangement. When one person is having a book bought by him, he will share with other. He is compromising his right to hold a book to give to him. That is a compromise. Even companies have the same thing called a compromise and arrangement. When it can compromise with its creditors or members, with whom it can compromise a company and its creditor or any class of them is nothing but a creditors. There are when 7% debenture holder, 8% debenture holder, 10%. These are the classes of debenture holders and its members. Next, when a compromise is happening, it cannot be done without the intervention of NCLT, National Company Law Tribunal. The first, the company who can make application to NCLT. The company, creditor, member, or a liquidator. Liquidator is a person who comes into when the liquidation takes place. He will set off the assets with the liabilities. These persons can make application to the NCLT. On the basis of application, NCLT will review it. When making an application, the person making it should have an affidavit. The affidavit should contain the material facts like an audited financial statement, auditor's report, and any investigation pending in tribunal case. After disclosing this affidavit, NCLT will review it whether it is justifiable or non-justifiable. If a company composes a scheme like it is having a due of 10 crore rupees to pay to its creditor, but in that scheme it only gives 1 crore rupees. This is not justifiable. So NCLT itself will directly reject this application. When it is justifiable, the NCLT will issue an order to hold meeting. NCLT will issue an order to hold the meeting. The chairperson will issue a notice to whom these shareholders, members, and debenture holders who should take place in that meeting. The notice is sent to the registered address of the creditors or members. The notice can also be placed in the website, in the website of the company, or issued in the newspaper. But the notice should contain the annexures with the notice. The notice should contain details of compromise, that the scheme the application is made, and a copy of valuation report. Valuation report is nothing but if a company is proposing a scheme to sell the asset and pay off the liabilities, the asset should be valued by the registered valuer that contains in valuation report. So it has also to attach the valuation report, explaining the effects of creditor and key manager, what effect it would have, the scheme would have on the creditors, KMPs and debenture holders. When the notice is placed on the advertisement, these annexures would not come in advertisement. So the company has to make these annexures available at the registered office of the company to make, where the notice for the meeting is also issued by an advertisement. It shall indicate time within which copies of compromise or arrangement available at the registered office of the company. If the persons who have seen the advertisement, they can go directly to the registered office to check the scheme and other available documents. The notice should also be sent to the sectoral regulators like a central government, income tax authority, Reserve Bank. The notice, why should they send it to these sectors, is that these sectors may have the objection to the proposed scheme. If shall require the representation. If they come back with within 30 days, the objection, it is cancelled. The scheme is cancelled. If no objection is come within the 13 days, it is presumed that they have no representation to make the proposal. When the application is made to an NCLT, the NCLT will accept or reject. But when it coming to the NCLT itself, there is at least 90% of the creditors are accepted it. The NCLT will straight away accept the scheme without conducting any meeting or issuing a notice to the creditors. Notice should be sent. The proxies, the who can vote at the meeting, either themselves or through proxies or through the postal ballot, within 1 month from the date of receipt of such notice. After receiving the notice, they have to conduct a meeting and through the vote. Who can raise objection in the meeting? A person holding not less than 10% of shareholding or having outstanding debt not less than 5% of total outstanding debt. At the meeting, how the proposal is accepted. If a meeting is conducted and 10 members are present there, how much is the majority to accept that scheme? When a meeting is held, majority of persons representing 3/4 in value of the creditors. 3/4 of, there is a two condition to this effect. The first condition is majority of person and representing 3/4 in value. If we take an example, there is a 9 members who have a shareholding of 10 lakh rupees. If a 5 members is accepting the scheme, but the value of shares is only 2 lakh, the scheme won't be accepted. If the 5 members have the value of shares total of 9 lakh, then the scheme is considered to be accepted. Particulars to be stated. After accepting this scheme, the NCLT will send the order to the company. It also will accept the scheme. Filing of order. After issuing an order from the NCLT, the company should file its order within the 30 days on receipt of order with the register of the companies. Exception in relation to buyback of securities. Compromise or arrangement or in respect of buyback shall not be sanctioned, and because there is a provision of section 68 which talks about the buyback. There are certain conditions to be fulfilled for the buyback scheme. Inclusion of takeover offer. Takeover offer is nothing but amalgamation or the purchase of shares of a company. Application to tribunal by the aggrieved person. If any of the member or a creditor is not happy with the scheme, they can make an application to the tribunal they can make application to the tribunal. The tribunal on application pass the order as it may deem fit. Power of a tribunal to enforce a compromise or arrangement. Section 231. The tribunal, after giving its order, it will supervise the implementation of the scheme, whether the scheme comes into effect, whether the company is making such arrangement to bring it to effect. It can also make modification to it. Winding up order by the tribunal. When the company is planning to pay off its debts and making a compromise or arrangement, and it's been accepted in the meeting, when the company is not doing it and is unable to pay its debt, the tribunal will straight away make an order to wind up the company. Merger and amalgamation of a company. The two important things is a transfer company and a transferor company and transferee company. Transferor company is a company which transfer its assets and liability. Transferee company is who receives the assets and liability or the shares of the company. Let's take an example. A is transferring the assets and liability to B, which is a transferor company, which is a transferring company. A is a transferor company and B is a transferring company because it acquires the assets and liability. Another example is A and B comes together to form a new company C. In this case, the transferor company is A and B. Transferring company is C because it accepts the assets and liability. In merger and amalgamation also there is a compromise and arrangement because when one company is compromising its assets and liability and benefiting the other company. So there is a compromise. So the same procedures will be followed. They have to make a filing of application to the tribunal under section 230. Circulation of information. What are the information to be given to the shareholders? First, the draft of proposed term. It should be accepted by the directors. Then confirmation of the draft of scheme. Report adopted by the directors. The report should contain the effects of compromise on shareholders, KMP and everything. Report of expert, that is a valuation certificate of assets and liabilities. Then the latest audited balance sheet of the company, audited financial statements of the company. Order of tribunal. The tribunal may order after sending these statements to the shareholders, the tribunal may order on these matters: date of transfer, transfer of instruments, legal proceedings, etc. Effect of an order of tribunal. Effect of order of when the assets and liabilities are transferred to the order. Where an order under this section provides for the transfer of property or liabilities, the property shall be transferred to transferee company, shall be transferred and become liabilities of transferee company. Once the assets and liabilities are transferred, it becomes the asset and liabilities of the transferee company, not the transferor company. Filing of certified copy of an order. The order issued by a tribunal should be filed with the register within 30 days from the receipt of the order. Effective date specified in the scheme. There should be in the scheme there should be a specified date on which this order will come to effect, and shall be deemed to be effect from such date and not at the date subsequent to the appointed date. When the scheme contains a date, the scheme becomes applicable only on the date, not at the proposed date on some other date. If a company is failed to give a note, file with the register, it has a penalty of 20,000 rupees and which may extend to 3 lakh rupees. Merger is of two types. When an existing company is taking over the assets and liability of the another existing company, it is a merger by absorption. When a new company is formed, it is a merger by formation of new company. Power to acquire the shares of shareholding. When a company is planning to acquire the shares of another company, it can make the scheme or contract involving a transfer. It has to approach the shareholders for the transfer of shares. The transfer of shares will take place only when the older shareholders holding not less than 9/10 in value. They have to accept that transfer of shares is okay. Time for receiving the approval. We have to get the approval from the 9/10 shareholder within 4 months. Within 4 months after making an offer. When they don't accept it or they don't accept the offer, another 2 months is given to them for accept after expiry of the said 4 months. order of tribunal to acquire the shares of. But even then they are not accepting, they can make a note application to the tribunal, and tribunal will look into it, which is beneficial to the company. Once shareholders accept the proposal, the transferor company thereupon register the transferee company as the holder of the transferee company is a company which acquires the shares of the transfer company. In the books of the transferor company will be the shareholder. Separate bank account to be opened. Separate bank account. The transferring company should open a separate bank account to transfer the fund to the shareholders of transferring company. Preservation of books and papers of amalgamated company. Once a company is amalgamated, it should not dispose the books of accounts of the transferor company after the amalgamation. It has to keep the books safeguarded. Liability of the officers in respect of offence. When it has a prospective effect. When before the amalgamation, the directors or the shareholders has done some offence committed under this act, it also continue after amalgamation. Merger and amalgamation in case of a foreign company. When the foreign company is merging with the Indian company, it has to satisfy, obtain a prior approval from RBI and comply with the sections 230, that is compromise and arrangement, and 232 amalgamation and of the act. The foreign company can pay through cash or in depository receipts or partly in cash and deposit. When an Indian company is merging with a foreign company, it has to comply with RBI regulations and follow the same guidelines as before. Thank you.